In today's video, we're going to look at a stock with a fresh news catalyst where we had a strong long bias. We got long the stock, we lost money. It was a good idea. So what we're going to do now is review our process, review the trade, and hopefully be better prepared for next time. Before we get into the nuts and bolts of today's trading idea, I wanted to remind you that we put together a 2-hour free workshop that goes in depth on our stock selection process. So how we choose our stocks to trade each day, including the one we're about to talk about, is in that 2-hour workshop. In addition, there are 3 high probability setups that are used on our prop desk in New York City. So if you're interested in those topics, click on the link above that is appearing. It'll open a registration page. You won't lose your spot in the video, and check it out. Most people really love the workshop. When we come up with a trading idea, we develop a thesis. And so I want to walk you through that process. Then I'm going to show you the trade that we took. We're going to review the price action from the time we took the trade to afterwards. And hopefully, perhaps there's some adjustments we could make for next time. Or perhaps these are just the things that happen in trading where we take good trades or we develop a good thesis and we lose. So first thing we do is we look at the catalyst. And when we look at a fresh news catalyst, we have a spectrum of a very negative catalyst to a very positive catalyst. And for myself, what I'm doing is I want to assign along that spectrum, and most times positive catalyst, negative catalyst, nothing overwhelmingly positive or negative. And this is important because when we combine that with the other parts of our trading thesis, it will help us to decide whether or not to have a bias. And quite often, if I talk about 4 stocks in our morning meeting, the way the morning meeting is structured is we have a written game plan, fresh news catalyst first, then second day plays and technical plays. When we go over those fresh news items, stocks with catalysts, quite often I'll just put no bias. And what that means with no bias is we'll develop important support and resistance levels, which is again part of our stock selection process, which is part of the workshop that I mentioned earlier. And we'll have no bias, which means generally speaking, we'll look for those stocks to trade in between those levels that we put in the morning game plan sheet. But if a stock has a long bias or a short bias, we may look for it to move outside of the levels discussed and then trend for the rest of the day. In this case, we're going to look at something that we had a long bias on in a moment. The second thing we're going to look at after we look at the actual catalyst and put that on a spectrum to very negative to very positive is how did the stock behave recently? And I've done some videos where you've probably seen me talk about this, how people are positioned poorly going into a catalyst, or they're positioned poorly meaning they're long and then a negative catalyst comes out, or they're short and a positive catalyst comes out. And this is going to inform how we trade the stock as well. We like to see people mispositioned. And so we'll talk about that a little bit when we look at the catalyst for today's stock and the charts as well. So the final piece is we have these stocks, they have a catalyst, and when something has a catalyst before the market opens, it's going to gap higher or it's going to gap lower. The size of the gap in itself, what I'm seeing in the pre-market, may influence my actual bias. So to give you an example, say something has a positive catalyst and it's gapping up a lot in the pre-market, so it's going to open up at a much higher price. But I don't view the catalyst as being that significant. Or let's say the catalyst is strong, but it's gapping up as much as the strength of the catalyst itself, so then I'll have a neutral bias, meaning it has a good positive news, closed the day before here, it's gapping up to here. I don't necessarily think that this catalyst is strong enough for it to actually hold that gap and to trend further. In fact, when we look at today's idea, the item that was the number 1 on our sheet is a perfect example of this. So before we get into going into detail of the stock we're talking about today, BURL, which had a very strong catalyst and we had a long bias, and we'll talk about the details of how we traded and we lost money and all that good stuff. The first stock is CRM on the list, which I wasn't going to talk about, but it's a perfect example of They had a solid earnings report. The guidance was solid, but it was gapping up into a longer term resistance area, and I didn't think that they raised guidance enough to really justify it trending to higher. So what we talked about in the morning meeting was, if it gaps up into this R1 area, 140, and fails, let's see what happens if it comes down into our support. And maybe we can just trade it between the support and resistance today, and that's kind of my neutral, that's a neutral bias. We look for it to fail at resistance, go down. We look for it to hold support, go up, and perhaps it'll trade in that range. In the case of something like BURL, which we're going to talk about today, is we are going to look for, on the open, it holding support, trending up to resistance, and if it actually starts to hold above resistance, we're going to look for it to trend the rest of the day and perhaps even take out the second resistance. And if it closes above the second resistance, it becomes a swing trade on the long side. And so the catalyst in the case of BURL was very strong earning per share on a revenue beat that wasn't that large. The reason why this is important, why I like this catalyst, is one of our favorite things as short-term traders is we like to look for things with expanding margins. Those are positive. Or contracting margins, that's negative. When we see expanding margins, those are potentially good intraday swing trades and can turn into multi-day swing trades to the upside. And so in this case, BURL, they did beat on the revenue guidance, but their EPS, they crushed. So we reverse engineer that, and what do we get? We get expanding margins. And they were conservative on the margins, they were conservative on their estimates for the following quarter, but this is a retail. We have the holiday shopping season through Black Friday through Christmas, and there's a lot of sales and things like that. And so maybe they weren't quite sure for this holiday shopping season they were going to have a large, they guided up in sales for the fourth quarter, but they were a little bit conservative, and that may be just because they're competing during that holiday shopping season. We all know that most retailers, even though they do, half their sales or something for the year then, sometimes the margins aren't as great, but as long as they have a blowout quarter, that's kind of what you're looking for. So we had a long bias. It was gapping up in the pre-market to around between 158 and 160. We didn't have a ton of volume, and here's a chart. We're looking at a chart, so you can see a couple of weeks ago, the stock was $180, and it just got sold down 5 days in a row from 180 all the way down to 145. That's a 20% down move, 2 weeks coming into earnings. So people clearly were nervous about earnings. They don't want to be along the stock at 175. They don't want to be along the stock at 160. It actually gapped down to below 155. That morning, it finally found some buyers at 145. You can kind of see that bottom little blue line there that I put in the middle of the chart. Was bought for a couple of days coming into earnings in the high 140s. And so the numbers come out. We see it in the pre-market. It's gapping to the high 150s. And my thought is, wow, this thing just sold off from 180 to 145. It's gapping higher, but this is really good news. And so what we could be looking at is a move back up to 165 today, maybe over the coming days 170 or higher. And so I wanted to buy on the open on a pullback. Now, something to understand is when a stock like this, a retail stock, gaps up $10 on the open, you're going to have some people who bought in the 140s the last few days generally that are going to sell. And you'll usually get a quick dropout before the bigger picture buyers take control. It gets above 160 and then trends for the rest of the day to the upside. And so what I'll look to do right on the open in that first 15 minutes is buy a dropout. And so I identified on the sheet, you saw 155, we had a support. I probably should have put S2 as 153. The reason why S2 would be 153 in this case is you can see that as it was trending down on the left side of the chart, it actually, the day it bottomed in the 140s, it could not get back above 153 over the next few days. It popped all the way up there and failed, and it got up there again and kind of failed. And so we knew that potentially this would be another spot if they didn't buy it in the 155 to 154.5 area. That's another spot where potentially buyers can step in. And that's known as a soft gap fill. I'm not sure, I've never really researched this. I came up with this term many years ago, probably 5 or 10 years ago, which is a lot of times you'll hear people talking about gap fill stocks. They'll have an event, they'll gap down, they'll gap up, and then over the coming weeks and months, technicians like to look for those gaps to fill. What I found as a short-term trader is you'll have something a little bit different. In this case, you can see the gap down to in the 140s, it'll run up that day and the high was 153, and then it gets accumulated for a while and it fails again at 153, is if you do get a good news item and it gaps higher, it may not completely fill that gap from the day that it had some sort of negative catalyst, what it'll do is come down to the high of that day where it bottomed and bounced and failed, and that's the 153. So that's your lesson on soft gap fills, which actually is, from a short-term trading perspective, can be useful. So just to recap so far where we are. We have a stock coming into earnings 2 weeks ago, came off 20%. People were selling this thing coming into earnings. Now, it was bought for a few days in the high 140s, but this is well off where recent prices. This is still 16, 17% below the recent high. We have good news coming in. Margin expansion is very important. And then the third thing is it's gapping higher, but the move from 180 down to 145, which is a $25 move, I expect with very good news, at a minimum, a 50% retracement of the down move. I think it actually could go to higher prices, but 50% retracement on good news, that takes us into the mid 160s. And that's kind of how I developed the thesis. Drop it on the open, gets back above 160, and maybe it trends to 165, 166, something like that. And then we'll see if it closes. Certainly if it closes above 165, we want to take it as a swing trade and look for higher prices. So here's what happens on the open. Right on the open, it drops very quickly from 158 to 155. You can see at 932, the resting bid gets hit at 155. And you can see it ticks up for a second to about 156. But then in that next 2-minute bar, it drops out $4, stopped out. 2 minutes later, it's actually above 156 and starting to show some strength, holding above 156. And we're still looking at, this is the first 20 minutes we're looking at. So that was quick. It was hit on the bid, stopped out below 53. Which was the soft gap fill price, went right through, very quickly went back up. There was really no opportunity to buy it. Now, one thing that you can't see on the chart, and most people, they do these trading videos and they talk about the chart and they say it's easy and then they show you the consolidation, like buy here. They don't show you this. This is the level 2. This is what traders are actually looking at when they're trading the stock. Now, I took this snapshot in the afternoon when the bid and the offer got narrowed to about 9 cents. This was not the spread on the open. The spread on the open was $1. So the bid was 65, the offer was 66. When the bid dropped at 65, it was down at 64. So the reason why the bid offer spread is so important, as traders, our number one job is to control our risk. Very difficult if you're buying it at 165 and the bid drops 64, that's $1 risk right there. It drops again, 63. That's kind of how we're measuring our risk. Now, right on the open, spreads are widest. This is the riskiest time. I'm going to go in small, very small, right on the first few minutes because of those wide spreads. That's going to do risk adjustment. Not going to take don't want to take a huge loss on the open because of these wide spreads when people are fearful of, people are fearful of putting in orders other than right on the first opening order, right when the market opens, and you have wide spreads. Usually, by the time you get to 9:45, the spread tightens. We were looking in this case for the spread to tighten to about 30 cents or so. But what happened was at 9:45, even though the price action got better, the spread was still 50 to 75 cents. As part of our review process, I want to take you through and let's see what happened at 10 o'clock, 10:30, to see if there was another spot to get involved. And I can tell you that a junior trader who assists me and was watching the stock, he was watching it very closely at 10 o'clock. And you can see it stepped up and their buyers were at 58. And so if you look at right on the left side of this chart, on this 1-minute chart, right on the open, boom, it was down into 52. Boom, it was back up to 57. And then over the next hour or so, we finally did get a tight consolidation around 158 to 158 and a half. And as he was telling me that and calling that out, he's saying the spread is still 50 cents. This is not, it's going to be difficult for us to control our risk, even though he wanted to get long and give it another shot. And so if you look at the chart here, it looks pretty good. I mean, it did drop out initially, that kind of, I've circled the consolidation area. It dropped out first to 57 and a half before it eventually trended higher. It trended up for about $10 over the next few hours. But right there, he felt like the spread was too wide. It hadn't come into a spot where he could control the risk. And I said, that's fine, then just don't put on the trade. But he was still looking for spots. The thesis was playing out. We were looking for a drop out on the open. We wanted it to rebid and show strength. We wanted it to consolidate, close to 160 and then break above 160 for a trend to the mid 160s. We did see that market behavior, but just like I showed you on the level 2, the spread hadn't narrowed yet. In the afternoon, the spread started to narrow to 10, 20 cents. Was more, could control your risk at this point. But you can see actually at this point, The stock was already at 168, so it was $16 off the low, $15 above where we had gotten stopped out. Just to give you the recap, we want to develop a thesis. The thesis is going to be based on the strength of the catalyst. Is it severely negative, slightly negative, neutral, positive, very positive, extremely positive? In this case, I thought it was very positive. I wouldn't call it extreme, but very positive combined with a stock that sold off a lot recently. We like the long bias. And then we want to have a checklist. Once the market opens, we got stopped out on that initial long right on the open. But what we want to do is continue to look at our checklist to know, we lost on that first try, but did the stock bounce right away in the first 15 minutes? Is it consolidating, in the top 25% of its range for the first half hour or so? Does it take out our first resistance level from our morning game plan sheet? If it's doing those things in check 1, check 2, check 3, we're going to continue to look if we can find a spot to get in and continue to give it another chance. And vice versa, let's say we bought it on the open like we did and we got stopped out. It didn't pop that much. It only popped back up to where we bought it and it started to roll over again and was consolidating at the low. Our thesis is refuted and we're actually not going to look to get long at that point. In fact, we might actually look for a good spot to get short. And that's what I'm doing in every idea, in every situation, every day. Is my thesis being confirmed? Is my thesis being refuted? And I'm generally going to give it a second or a third try if I can control my risk. Because these are ideas that we spend time formulating, and these were the best in play names, and we were pretty good at identifying strong catalysts and levels, et cetera, et cetera. We spent a lot of time teaching that and doing that. And so in this case, we lost, we didn't get back in. I thought it was a good example, though, of it's just that trading is a probability game. It didn't work out initially. We didn't get another shot. We didn't get another swipe at it, and it didn't work out. But I think there's a few things here in terms of that you can take away in developing your own thesis. And again, this process of developing a thesis, selecting the stock, it's the click below the video, the 2-hour workshop. I spend a half hour going through this. I know I always get emails and messages on Twitter. Steve, could you go into more detail to the process? Yeah, I spent a half hour going into that process in the workshop, as well as giving you trading setups, good risk reward short-term trading setups. So check it out if this is a topic that interests you.